Good afternoon, everyone, and welcome to this session in the Kepler Trust Intelligence Conference. In a moment, we'll be hearing from Matthias Siller, who's manager of Barings Emerging EMEA Opportunities. Until recently, the trust was known as Barings Emerging Europe, but was renamed as the strategy evolved and the mandate widened, which I expect Matthias will talk more about shortly. We've also recently published an updated note on BEMO, which you can turn to for some detail on this on the site. It looks like the trust was trading on a discount of around 11% as of yesterday's close, and the historic yield is about 3.4%, but notably the board can pay out up to 1% of NAV each year in the dividend too. So we have around 30 minutes for the formal presentations, with 50 minutes available for questions, and we need to be quite tight on that because we're doing back-to-back sessions, so I apologise if we don't get to every single question. If you haven't been on one of these sessions before, most of you probably have by now, but you should know that you're muted. And if you wish to ask questions, please use the box to the right. I will collate those and put them to the manager at the end of the session. So with no more to say, I will pass over to Matthias.
Thank you, Thomas, and good afternoon to everyone. Thank you for giving me the opportunity to present on Barings Emerging EMEA Opportunities, which is managed by me together with a team of fund managers and analysts at Barings. The strategy I am focusing on in Barings Emerging EMEA Opportunities is to generate an income diversifier and to invest into undiscovered growth opportunities in EMEA markets by creating a high conviction portfolio focusing on a diversified set of growth trends and mispricing opportunities. By that, we believe that we can generate an environment where the investment rationale presents itself as follows. Firstly, I think, I do hope that I can highlight in the next couple of minutes why we think that EMEA equity markets present quite a unique pool of undiscovered value from the perspective of a global equity investor. Secondly, I hope I can highlight that by making use of our investment process, which also incorporates a very good amount of ESG considerations, we end up in building a concentrated portfolio that gives shareholders exposure to an average of 40 to 45 and in the range of 30 to 60 stocks in the wider EMEA region. And lastly, I'd like to highlight that this is all being considered from a long-term perspective. So we are in a situation where we find ourselves, and I would say the lucky situation that we see long-term growth trends emerge across the entire region. They express themselves differently in different geographies and countries, but they will lead, we believe, to a clear separation on the stock markets between winners and losers. And we obviously try to benefit from that. Now, when I talk about EMEA, it's, I think that very often a picture says more than 1,000 words. And, this does exemplify that here. This map does exemplify that here quite well. So, obviously, if you, look at that picture, this represents a good part of the entire world. You might say, however, don't be fooled by the fact that our investment region spans from the Pacific, from the borders of North Korea, across Central Asia, across the new EU member states, into North Africa, across this into Sub-Saharan Africa and South Africa. That is a relatively unknown portion of the investment world. And I'd highlight that in a bit more detail in the future. What is interesting here is to say that these vast geographies and different countries represent obviously only don't represent every single country in the wider EMEA region. That has to do, of course, with the development of the underlying liquidity of secondary markets, secondary equity markets. It's just not given everywhere. We do expect, and we are hopeful that over time more and more countries will join the fray, enlarging our investment opportunity. But for the time being, For the time being, the investment universe, as highlighted by countries, represents itself in the way that you see in front of you. The important point is not so much how many countries are represented in the investable EMEA space from my perspective, but the notion that we believe we can show that these geographies are, yes, they are relatively underrepresented, and yes, they are relatively unknown from the wider perspective of a global investor, but it doesn't necessarily mean that investment in EMEA has to come at a high risk. I believe that we can show that the underlying trends across the geographies do give exposure and do give opportunity to diversification effects, which we certainly want to exploit for our shareholders. This, by what I mean is that the low correlation of different developments across different sectors should generate a portfolio that is less risky than investing into any one of those countries alone. Right? And Thomas was kind enough to highlight in his introduction that that there has been a certain evolution in Baring emerging EMEA opportunities just recently. And yes, indeed, we have before managed an portfolio that was entirely focused on emerging Europe. And this has now changed into a wider EMEA mandate. And by that, we wanted to make, first of all, use of the opportunity set that we saw across the entire region, and in a way expand the pond we were fishing in. But more importantly, we saw that there were very good diversification effects to be had. So we are of the opinion that we have to give up, hopefully, hardly anything of the opportunity set and of the long-term portfolio growth potential, but we could gain, much higher correlation effects by doing that, obviously leading to a much better risk-return relationship, which is something that our investors actually did agree with, and therefore supported us in actually creating or working towards an eventual evolution that took place just a couple of weeks ago into a wider EMEA opportunity set. So one country that has formerly featured very prominently in the portfolio was Russia, given its dominance over emerging European equity markets, and also given the opportunities that we saw there. This is not any longer the case. We have been, I think, rightfully criticized in the past that our portfolio resembled much more a single country fund, with an exposure to Russia of up to 55 to 65%, almost 2/3. This is certainly not any longer the case. We now have, given the evolution that took place, I can report, I'm very happy to report that the underlying portfolio structure is now much more diversified across the very region that you see in front of you, with the largest market being Saudi Arabia, South Africa, and Russia. So it is essentially Central and Eastern Europe, the Middle East and North Africa region, and the Sub-Saharan South African region, seeing their main components in Russia, Saudi Arabia, and South Africa currently. We want to highlight that by doing that, we also, not only do we gain a broader diversification across country borders and across sectors, geography, so to say, but this also includes a wider set of currencies, obviously intricately connected to the underlying economies, of course. But we are of the opinion that after the last couple of years, which saw, quite substantial devaluation trends, and I don't mean don't necessarily only mean inflation, but devaluation that went above and beyond the underlying inflation trend, so a real depreciation of the underlying currency basket, leads to a situation where on purchasing power parity, which is arguably a measure that holds only in the long term, but that's how we want to invest, that on purchasing power parity, we see also very attractively valued currencies across the region, and which should, if you ask me, be supportive for income generation going forward as we collect dividends underlying currencies, of course. And in the case of the new EU member states in Central Europe, it also highlights, I think what is an attractive exposure to European currencies that stand outside of the euro and are not plagued by the same difficulties and issues that you currently find in the in the EU periphery in countries such as Italy or Spain, for example. So also currency, but I want to mention that it's not only about, from our perspective, about considering the exposure and the potential in equities. We do understand that there are also cross currents such as currencies, and we believe that these currents that I just reported from, might well turn into a tailwind for the next coming years, something that was, rather a headwind for income generation in the last couple of years. So there should be, an additional effect of diversification, if you ask me. Now, I've highlighted that we briefly touched on income generation in the previous slide, and in my introduction, I highlighted that it is the ultimate aim to us to find a nice balance between exploiting what we think are very unique and great opportunities with regards to long-term growth prospects across countries and across companies in various countries in EMEA, and a substantial underlying income generation, a sustainable and growing revenue generation from the underlying portfolio. We consider ourselves to be in an extremely lucky situation here. As highlighted to you, we truly believe that we can generate or we can build a portfolio that will benefit from low correlations of the underlying trends in various countries. And at the same time, we do not have to compromise on a proper and solid income underpin when we go even in an environment where we expose the portfolio to long-term and attractive growth trends. So from my perspective, Barings emerging EMEA opportunities does allow, I think, a rare feature to express itself in a portfolio, which is a solid and deep and a solid conviction on growth opportunities, and at the same time a very attractive income generation that's also set to grow over time and is therefore sustainable. This is for me the most attractive feature of Barings emerging EMEA opportunities. And I do believe that this is a great feature to add to anyone's portfolio. Now, it's easy to talk, how did we walk the walk in the past? Slide 5, the one that you see in front of you, highlights the income generation or the dividend generation by my portfolio. Mind you that the board, is very supportive of or conducts a policy of distributing the entire revenue generated. So in other words, the DPS that you see in front of you expressed in pence does correlate highly to the underlying revenue generation of the portfolio. And you do see that the last couple of years were indeed quite successful in exploiting the opportunities that I just highlighted to you in what used to be confined to emerging Europe and is now a wider mandate of EMEA economies. Now, 2020, of course, was impacted by COVID. If you ask me, it's a very respectable result, right? We kind of lost 1/3 of our income generation, which I think puts us in good stead compared to other income funds. So I'm quite confident that we have not only kind of managed risk very well, also on the income front. Essentially, we fell back to levels last seen in 2016. Still, generated a higher income than in 2016. But more importantly, the future, I'm very confident that we are currently, seeing a scenario unfold that will soon propel us back into the income generated in the last couple of years, 2018 and 19. So our Short-term goal, if you want, on the income side is to reclaim the all-time highs that we have achieved in the years 2018 and 19, albeit in a somewhat more diversified portfolio, as we are now obviously investing into the broader area of EMEA. So this is the backdrop. Now, but we are certainly not, we will certainly not be satisfied with that alone. Highlighted to you that our aim is, and that's also important for me to communicate here, that this is not a level, not a plateau, but rather another step into what we believe is going to be a growing underlying dividend yield, which, as I highlighted before, might well see the additional boost of a broader appreciation trend across EMEA currencies, while the arguably success story of the last couple of years actually happened against the backdrop of a real depreciation of EMEA currencies. One big element in the past used to be Russian energy stocks that have contributed hugely, not only to the absolute amount of income, but also to the strong growth of it. And that explains very well also our motivation to seek this broader diversification here and now. We do believe that the fact that Russian energy names, Russian super majors, Russian oil companies have outperformed their global peers, and they're really peers. The likes of BP and Shell, of Exxon are true peers in terms of scope and scale of those companies. So why we have seen this substantial outperformance of 150% plus over the last 5 years is mirrored in this particular image here. It is the fact that those companies have started to be run more efficiently by I would say a more motivated management team, and that they not only were not only able to distribute these gains and these cash flows, but they were also willing to do so, and that was a big game changer. Now, this is again the past, and we think that from here there's much less efficiency gains to be had. I would go as far as to say that the very low correlation of Russian oil companies relative to their global peers is now certainly a thing of the past, and that going forward we think that there's not such a big differentiation to be had between, let's say, a Rosneft or a BP. I name those two companies because they're also intricately interrelated. BP is the largest non-state shareholder in Russia's largest oil company, Rosneft. And whilst Rosneft has outperformed its parent or its shareholder quite substantially on the stock market, I think going forward this is not going to be the case any longer. So what an opportune time to diversify the portfolio, diversify away from hydrocarbons, where we see a very limited long-term future, hopefully, and also do that at a fantastic moment in time when markets just conclude their year-long appreciation of what was a substantial increase in cash flows for shareholders in Russian energy companies. So this is one of the prime motivations why we think it's now a very good time to diversify the portfolio. And our aim is to generate an underlying income that is similar to the income that we generated before. Why we believe that why we believe that we have a good opportunity to continue to exploit what is at best, I would say, semi-efficient stock markets is highlighted on this particular page, or I think it's highlighted very well on this particular page. Even though we talk about quite a vast area on the globe and a substantial share in the global economy and the global population, EMEA is just a drop in the ocean when you compare it to global markets. Sorry for that. That was I'm looking after my son. Sorry for that. I do apologize. So it is just a drop in the ocean in world markets, and therefore I think it's fair to say that this, what is for some people confined as a sideshow, can continue to develop in a matter where bottom-up research and information gathering does indeed pay off and gives you the information advantage that we will use to find our high conviction portfolios. Now, look, for example, even if you take parts of it, slice and dice it if you want, and look at Europe per se, right? A good portion of our portfolio is still Europe bound. A good portion of our portfolio is indeed still in the European Union. We do represent, when we look at European funds, we also come to the conclusion that this part of Europe, which represents still about 35 to 40% of its population, is hardly reflected in European equity funds, which mainly cater and care for Western European companies. So even in the smaller parts, in the pockets within this, what we would describe a niche, we do believe that an environment of, at best semi-efficient stock markets will remain for time, which certainly gives the broad, I think, very experienced team that I, have the privilege to work with, the opportunity to conduct a true bottom-up analysis of the entire universe available. It sounds preposterous to say that, but you have to take into consideration that the wider opportunity set in EMEA markets is approximately 150 to 200 stocks. So this is an amount of stocks under coverage, which is manageable by a team of about six people at Barings. And out of which we want to distill a high conviction portfolio of between 30 and 60 names. The next slide, 7, just highlights the correlation. It's just a reminder of what I've highlighted before. The underlying correlation trends are best depicted by just remembering how high the overall correlation of, let's say, the European market is to global markets. So the green line highlights the 1-year rolling correlation of Europe against the all country world index. It's both MSCI in the same currency, of course. So the 1-year rolling correlation over 20 years has hardly ever budged, right? And it was extremely high. So you would actually question the diversification benefits from that, from both a performance but also income perspective. If you throw EMEA markets into the fray here, and that's highlighted by the gray and by the blue line, you do see that EMEA compared to an all country world index, but also EMEA compared to Europe, and that would then be Western Europe, is far less correlated in a 1-year rolling environment. And that, even though this is obviously the historical method, but I hope I actually highlighted to you why we believe that this correlation benefits might still be around. You do also see that in this recent worldwide recovery trade and cyclical recovery, that we, in the hopes that are generated by, the belief that we can overcome the pandemic eventually. You do see that the correlation, of course, spikes, right? So you do see that EMEA does benefit and does take part in what is a very, of course, synchronized recovery globally. But if you leave this, one-off events out, you do see that the normal correlation is much closer to 66%, so 2/3. And that's, that's in the wider spectrum of international correlations, actually quite a low number. So the message here is we believe there will be diversification effects for a portfolio, both in terms of income generation, but also in stock appreciation. This is my team highlighted. These are the 2 team members that I most closely work with, Adnan and Maria. Very happy to have them working with me. Great individuals, great investors, if you ask me. More importantly, beyond that is, that they help me, that we cooperate and we are helped by a team of analysts that essentially, makes use of, I think, very basic stuff, right? We're not trying to reinvent the wheel here, but we try to intricately know the companies that we invest in, and build a portfolio, a diversified portfolio from there, following a tested Barings approach that focuses on growth at a reasonable price and integrating ESG to a larger and larger extent. Not only because we think it's the right thing to do, but we also deeply committed to the cause and believe that the market is also going to appreciate improvements in ESG. And like I pointed out to you before, we have had a first-hand example from Russian super major or energy super majors, where we saw, how a turnaround in an ESG approach, can really yield fantastic uncorrelated results going forward. This is to exemplify the potential that we see in the markets for the next 2 years. There's no correlate. I think it's fair to say that there's little diversification to be expected from here. So this V-shaped recovery is probably something that you find across various presentations, and of course in the growth expectations across the globe. So my point here is that first of all, this shall be a reminder for me, highlighting that we do believe that we can reclaim the income generated in the past very soon. Obviously, income is driven by earnings. You do see that earnings are bouncing back quite rapidly. The BMO is Baring Emerging EMEA Opportunities is currently trading around 730 pence. The all-time high in income generation was 35 pence. So I'd say, we will move into striking distance at the current share price. We will soon move into striking distance of generating an underlying yield of between 4.5% and 5% at current share price levels. So this is, if you want, the near-term target, and this earnings rebound that you see in front of you shall support this near-term target. It says nothing about, of course, performance. I just wanted to highlight that. And it says, even more importantly, it says nothing about relative performance to the benchmark that we want to be valued against or evaluated against. But I highlighted to you that I think that we think that our profound bottom-up research, combined with the fact that we believe that information will be will arrive at markets in a semi-efficient way, that we can actually garner and continue to hopefully perform in the way that we did in the past, which led to substantial outperformance over the relevant index. Now, a lot of people have recently asked about the state of value versus growth. So like this big factor discussion that we had, that markets saw in the past, and that you're sure all very aware of. Now, if you believe that the value factor will have a bit of a better time in the next couple of years, or certainly better than the last decade, BMO is Baring Emerging EMEA Opportunities is certainly worthwhile being added to your portfolio, I believe, as EMEA equity markets, as far as I can see, are the most attractively valued on the entire globe. At least, I don't know any more attractively valued geography across the globe. Even if you have a quick look here on slide number 10, comparing it to emerging markets, or the all country world index, you see that not only are EMEA equity markets substantially cheaper, they have also re-rated to a far lesser extent in the past than what we have seen in emerging markets or in the all country world index. So if there's so not only could allows this for potential good performance on the back of a style rotation, but it would also potentially allow for a certain amount of re-rating potential, we believe, which would amplify performance going forward, certainly. Now, if you can just let me wrap up about the main building blocks of the investment rationale on the standalone basis, so not from an overall portfolio perspective. Hope I highlighted the income generation potential, the performance prospects, that we believe in. But from a standalone perspective, I'd like to highlight a couple of sectors where we think that investment in EMEA equity markets makes an awful lot of sense. Let me start with financials here. A sector that is probably was highly criticized by investors, and judging by the performance in European markets at least. It was a rather lackluster performance. In the US, a bit better. In EMEA, we think that the conditions in EMEA are substantially different from Western Europe and the European periphery. We think that we talk about, first of all, we talk about growth companies. We do believe that EMEA financials can grow. We think that they can also compete. Yes, there will be a lot of disruptions from their own ranks we want to highlight. So we think that in a way, we are saying that, we think there's also, there's a big and attractive pool also for stock pickers, winners and losers in these sectors. But overall, we think the sector is well capitalized and is subject to a strong underlying growth trend that comes from demand. Talking about demand, this is a good segue to the consumer sectors, where we do believe that penetration, we believe that household income is set to grow. I think that there are countries that have seen quite a disappointing trend line on that front. Other countries have done very well. Overall, we believe that the next couple of years, 5 years plus, we'll see quite a substantial household income growth across the wider region of EMEA. And we do also believe that households are not necessarily subject to the very same demographic trends that we see in other parts of the world, especially in the developed world and in developed Europe. We think that it's fair to say that yes, part of our economies, such as the Czech Republic or Russia, are not to be considered young demographies, but other parts such as South Africa, such as Kenya or even Turkey, are certainly very young demographics. And so we do think that there's also a demographic dividend to be had in the consumer sector going forward. The interaction of the consumer sector with technology is particularly interesting from a lot of levels. We think there has been a certain amount of emancipation in EMEA, where we see that global companies are actually that local companies compete very successfully with global companies on the technological front. To us, it is enormously important, as it is testament to the abilities and to the homegrown talent, both in terms of entrepreneurism, but also certainly in terms of education and the overall education system. So we do see that on the tech front, if you want, be it e-commerce, internet, be it B2B software, be it fintech, we do see that homegrown talent actually not only competes successfully, but actually edges out a market share gain against the global power fintech and e-commerce and internet powerhouses. That's certainly very reassuring. More importantly, from the perspective of an equity investor here, is that we see a lot of those companies coming to the market. So there's a wider, breadth and depth and high liquidity to be had, and a wider scope for investments in EMEA from this public offerings. Certainly a very good development. Lastly, on the energy front, I highlighted our motivation to diversify away from Russian hydrocarbons. I hope that came across very solidly. We really believe in this pivot away from hydrocarbons. But we want also to highlight that we think that the last man standing in the hydrocarbon arena, so to say, will be Saudi Arabia and Russia, especially under much more ESG focused investment environment, as we can demonstrate that Saudi and Russia are essentially those countries that do expose hydrocarbon generation to the smallest carbon footprint. If you and we believe that this exogenous cost will become internalized going forward, and that CO2 will become a true cost factor for global hydrocarbon companies. Who would stand to benefit in this along this industry is certainly Saudi Arabian and Russian companies. where we already now see the lowest lifting costs. So this would only amplify the already existing advantage in terms of low lifting costs. And that's certainly a big positive for Saudi Arabia and Russia. And lastly, how does this express itself in our portfolio? We thought that by just, skimming across a couple of stock picks in our portfolio across sectors and regions could give you, a bit of a taste of how the portfolio is being structured and across, which kind of lines we make our decisions. So if you start on slide 12 and focus on South Africa, you see that there's certainly a combined exposure of financials and tech. In this particular case, it's Discovery and Naspers, where we do see interesting investment opportunities from very different angles, but what unites them is certainly a strong drive for growth. In Saudi Arabia, we have highlighted a dominant bank. It's Al Rajhi, where we believe that first that in this current environment of perking up interest rates, this bank could really make a difference as it has a unique access to ultra low cost deposits, and therefore can capture the potential upswing in interest rates almost undiluted. And we think the market, is slowly coming around that this is a bank that stands to benefit enormously from a somewhat higher interest rate environment. And it does expose, and it does also a good amount of business in asset management and brokerage, which is a subsector in Saudi where we believe will feature prominently with regards to growth going forward. If you go into, if you step away from EMEA and if you step away from Middle East, North Africa and South Africa and go into the former Soviet Warsaw Pact countries and the former Soviet Union and the new EU member states, we highlighted 3 companies for you here, focusing on financials to start with in Poland and in Russia. PZU, probably it's a relatively unknown company, I would say, but it's the largest Polish insurer. We love how they move into life sciences and the amount of and asset management. They have, I think, from our perspective, also made a very smart acquisition in the banking sector. So they're now consolidating the banking sector, holding minority stakes but absolute control, and using this quite well-run large chunks of the Polish banking sector and turning them into a profit center and a distribution center for their own products. So far, PZU wasn't very active in bank assurance, and this is giving them, I think, a very good opportunity to increase earnings in the future too. This is the highest dividend payer in the portfolio, if I'm rightly informed. We expect a 13% dividend from this company to be paid out in September. So that also quite side remark on the dividend potential that we see. Sberbank is much better known than PZU. I don't want to tell you that it's the largest Russian bank and so on and so forth, but we do think that it is on the path for a reinvention of its business model. More than that, I think it's already living the reinvention of its business model, which will eventually turn it into a Chinese-style super app for Russian consumers. A quite unique story, I think, on the global level. Also a strong dividend payer due to its huge and solid capitalization. And we also think a management that is not only visionary, but also understands the needs of shareholders like us. One of the few banks in Europe that didn't that actually did pay a dividend and quite a solid dividend from 2019 earnings last year, and did not kind of use the environment, no disrespect to the European regulator on that front, but I think it was truly outstanding by Sberbank and the Russian authorities to allow Sberbank to go ahead with solid dividend payments in 2020 out of 2019 profits. So that's certainly a differentiator, if you ask me. Lastly, Turkcell. I think telcos are a very attractive investment opportunity here. It's quite tightly related to household income. In Turkey, the entry package for Netflix stands at 14 lira, which is or 16 lira, which is just under two pounds per month. That is, of course. So you do see how global tech champions as Netflix do kind of cater the product or to tilt the product to local pockets and household budgets. But we think that what this means to us is that the underlying thirst for data in Turkey is going to be very strong. We love the fact that Turkcell sits on a state-of-the-art infrastructure, so they have invested in the past. And we do think that they will now be able to monetize the investments into their assets in a much better way going forward. The average ARPU is just beneath £4 per month. Average rate per user is just the average mobile phone bill is just under £4 per month, and we do think that this thirst for data will create an environment where Turkcell and also their competitors can price their services in a better way without actually really making without actually households feeling anything, because we think an increase between 2 or 3 pounds per month is easily manageable, but that would express itself in a growth potential of up to 50% and more for Turkcell. It's also a solid dividend payer with an additional catalyst of a tower sale and asset sale. I highlighted the world-class infrastructure that they have, and they own it, and they could sell and lease back part of it, which would be an additional income generator, which would then express itself again in higher dividends. Yeah.
Matthias, I wonder if we could turn to a couple of questions.
Fantastic.
Sorry, everyone, if we don't quite cover everything, but there were a couple of questions around ESG. So I suppose relating to energy, but then also the politics of Russia and Saudi Arabia. How do you factor ESG into your thinking, and how do you view yourselves as sustainable? You're on mute, Matthias. Sorry.
Thank you, Thomas. So part of the answer here is that we do certainly acknowledge the issues around hydrocarbons. I start with hydrocarbons and the Russian oils. We do acknowledge the issues about hydrocarbons, but we think they're also part of the solution. Let me give you an example. We think that gas, for example, is a bridge fuel. If you look at abatement costs across the global CO2 curve, so where could we get the biggest bang for our buck in terms of reducing CO2? The switch from coal to gas in the medium term is certainly one of the areas where you could have the biggest impact on the global CO2 footprint with a relatively small amount of money invested. So we believe that Saudi and Russian gas and also Qatari gas will play an important role as a bridge fuel to turn the global coal generation fleet into the first step into a gas and renewables fleet. So this is one part of the answer. The other part is certainly that we do hold management accountable for the impact of their policies on the environment, and we want to learn to what extent we will improve their efficiency going forward in producing oil and gas. So focusing on improvements and also holding them not only accountable for the direction of travel, but also understanding what goal will ultimately be achieved by that. So this would be my answer on hydrocarbons. But the overruling aspect here is that we are tilting away from what used to be a much higher portion of hydrocarbons in our portfolio. And we believe that one day we won't have any hydrocarbons in the portfolio. It's just not now the case. Secondly, on geopolitics, well, we think that as investors and as proponents of market economy, right, and by also expressing our belief that transparency, matters on many fronts, on the society level surely, but also with respect to listed equity, we can participate, we can contribute, right, to tilting management, but also whole societies into the right direction. That's what we want to do. Therefore, we confront management, like not on the society level, right? Management is responsible for this particular company, but we do in our ESG engagement with companies, we do promote transparency and, if you want, democratic values. Give you an example. One of our most successful stocks in our portfolio, London-listed Russian company, had not most successful in terms of stock market performance and also underlying economic performance, did not make use of a whistleblower policy in their company statutes. It's not. I think it wasn't malicious. It's just this concept is just still relatively new to Russia. So we engaged with the company, and I might say that it was us and maybe also other investors, but it was investors who actually opened this discussion, which was proactively taken up by the management, which then went on to introduce a whistleblower policy in its corporate statutes. So I know it's only a small step, but I think it's a step into the right direction, and it allows us also. It's hugely motivating for us investors to see it's not only to see what taking up this responsibility can actually lead to. On a broader basis, from a country perspective, we do apply higher risk ratios for countries like Saudi Arabia or Russia, especially Russia, which is certainly subject to geopolitics and geopolitical risks. Therefore, we approach a higher equity risk premium to it, and therefore deal with it in this particular way.
Thanks, Matthias. So maybe one final question, which has been sitting there for a while, asking about the liquidity in the shares. So there's a reasonably large bid-offer spread, relatively low trading volume. Is that something that the manager or the board can and will address?
To be honest, I don't bother too much about that, right? I mean, of course, I'm not happy about it, but what I try to influence is making sure everybody out there knows about the opportunity set. I highlighted that this is we think that Baring Emerging EMEA Opportunities has a role to play in anyone's portfolio. I hope I made that clear. But it's certainly not a trading stock, right? And therefore, if it were, if I were a quick trade, I would be much more concerned about bid-ask spread. I think this has much more of a longer-term investment characteristics. Therefore, I'm not bothered. I don't think that they're overly diluted by the fact that bid-ask spread is not ultra thin. But of course, I'd like to see more liquidity coming into the name. I believe personally that the signs are pointing into the right direction. I think that EMEA will be rediscovered by investors globally. And I think this will ultimately lead also to somewhat high liquidity in Baring Emerging EMEA Opportunities.
Fantastic. Well, thanks very much, Matthias, for your presentation, and thanks to everyone for your attendance and your questions. And apologies we didn't get to everything, but I'm afraid I've been ordered to be quite strict on the time because of the upcoming session. So we will try to put your questions through to the manager afterwards.
I welcome it. I will look forward to that and will respond to all of them. Thank you very much for the time and for the invitation. Thank you. Bye-bye.
Thank you, Matthias. And to our audience, if you wish to stay on the line, our next session will be with James Dupper of Majedi at 3 o'clock. Thanks very much.